Hello everyone and welcome back to this series of videos on the Solow growth model. Specifically in this video, we are going to delve into what actually capital per worker means and what is this level of capital per worker in the steady state in theoretical terms. So what does it look like? What do we need to get there? So a lot of this video is going to be a repetition of concepts mentioned in and actually explained in more detail in previous videos. But basically now we're just trying to summarize all of the tools to get to the final algebraic and graphical derivation of this concept, capital per worker, which is actually one of the main takeaways from the Solow growth model. So to begin with, let's ask ourselves, why do we care so much about capital in per worker terms? So we actually care about it more than capital in aggregate terms. Why is it the case? Well, in general, it's because capital alone does not tell us how prosperous or productive an economy is. And what do we mean by that? So let's try to figure this out through a numerical, very simple example. Let's suppose we have two countries, country A and country B. They both use capital and labor as factors of production. Specifically, they both have the same amount of capital in productive terms, in aggregate terms, sorry about it. So if we were to look at capital in aggregate terms, we would basically say that both countries are productive in the same way. However, we would be wrong if we failed to look at how many workers there are actually in that country. Because if, for example, country A has 100 people working with these 1,000 machines, while country B has 1,000 people working with these 1,000 machines, if we were to calculate the level of capital per worker, which we do by dividing the total amount of capital available by the number of workers that can use them, for country A, we would do 1,000 divided by 100, which would give us 10 machines per person. And for country B, we would do 1,000 divided by 1,000, which would give us one machine per person. So even though these two countries have the same endowment of capital, the number of machines that every person in each country gets to work with is significantly different. So what do we mean by this? Well, for example, we could argue that people in country A are more productive. Country A is more productive. Why? Because people manage to, work with multiple machines at the same time. There is maybe a lower cost of factor inputs because there are less wages paid out, and hence we end up with a greater output. However, maybe these people are overwhelmed because they need to use too many machines. And maybe it's more efficient to work with one machine at a time, meaning that country B is more productive than country A. So you see, the aggregate number of machines that each country is endowed with doesn't tell us much about how productive a country is. We need to look at the number of machines that each worker gets to work with to actually determine the output per worker, so how much each worker produces, consumption per worker, and therefore now we can infer the long run standards of living of a country. But let's now ask ourselves, what if both capital and the number of workers double? Does this improve the standards of living of a country? So this is another reason why using capital per worker is very, very useful. In this case, we doubled the number of machines in both countries from 1,000 to 2,000. And we also doubled the amount of people working on those machines. So it looks like, compared to before, both countries are way more productive. Why? Because they use more machines. However, we failed to take into account that they also have more people working. And so if we go to calculate capital per worker again, we would do for country A 2000 divided by 200, which would still give us 10 machines per worker. And for country B, 2000 divided by 2000, which would give us again 1 machine per worker. So even though in this case, output in aggregate terms would double, and this is thanks to constant returns to scale, which is an assumption about the production function that we make. And if you want more info about what this assumption means, you can refer back to video 6 in this playlist. So even though output would double thanks to constant returns to scale of the production function, there would also be double the people enjoying this extra output. Hence, nobody would actually see an increase in their standards of living, because the amount of output per worker that would be faced by the population would probably be the same as before. Why? Because the capital per worker that is implemented, that is used by people, is the same as before. So in order to actually make international comparisons and to have long run, let's say, information about the productivity and living standards of people, we need per worker variables. So a takeaway is that per worker variables allow to infer long run productivity and living standards of countries, plus to make comparisons. So now let's go back to a bit of theory and let's look at the capital accumulation equation in per worker terms. So we are assuming that we have no technological progress such that our exogenous technology term in the production function is equal to 1. And we have no population growth, meaning that our labor force is constant. So our capital accumulation equation in per worker terms is going to be very similar to what we saw for aggregate terms, with the only difference that we are going to be using small k's, where kt is equal to big K over LT, and a production function here that basically refers to output per worker. And again, if you want a more clear explanation of how this is derived, you can refer back to video 11 in this playlist. So now let's have a reminder of what a steady state is. As we mentioned in the previous video, a steady state occurs where capital tomorrow equals capital today, meaning that we are at a fixed level of capital and capital is not growing anymore. Again, it's a long-run equilibrium where capital stock and output remain constant, meaning that they have a zero growth rate. And intuitively, we've already mentioned that this is going to occur when the investment into new capital is going to equal to the depreciation of the old capital, meaning that the new machines that we buy equal the machines that break down. And algebraically speaking, in per worker terms, it means that our investment part of the equation, using the steady state definition of capital, equals our depreciation rate times our steady state level of capital. However, we just mentioned this as a, intuition derivation. Is there a way to actually derive this algebraically? Yes, there is. And we are going to explore how to do that in the next video, specifically applying the Cobb-Douglas production function, which we've already seen it's the best production function that we can deal with in such a scenario.